Hi, I'm Dan Frischberg. Thanks for coming. Last night, one of my favorite stocks and part of my macro trend portfolio, Buffalo Wild Wings, got absolutely crushed. Not because of bad performance. See, we're talking about Buffalo Wild Wings, the restaurant. And actually, yesterday, they announced just how well they've been doing and just how much money they've been making. You can see since inception on June 24th of last year, my subscribers have done great with Buffalo Wild Wings, and you can see it's way ahead of the S&P 500 anyway, even after all this. Well, first of all, most of the video you're going to see right now, I made a couple of months ago. And I said in that video, the World Cup of soccer and a few other factors were going to make this stock a fortune. Then after the big show, I expected kind of an anticlimax for a while till football season. In this tutorial, I showed a blueprint for a short-term sequence way back in May. This stock will make us money, in my opinion, for many years. But this is a simple way to collect a lot of rent right now from over-anxious speculators. And now, the sell-off is here, right on schedule. Buffalo Wild Wings made a fortune as we expected, but they also told the market they were going to have a little break in between, and the stock came down around 12% in one day. Now you're going to see why I'm perfectly happy with this, and this video shows you how to take big profits in advance and also reduce risk by widening the safety zone, which is what's benefiting me right now. Enjoy the video. You may have some questions about it, and you can call me live on the radio or email me, and I'll do my best to answer you. The most fun for everybody is going to be if you would like to call me live on the radio at 10 a.m. Eastern Time, 305-541-2350. This is my Buffalo Wild Wings story as of May 2014. And this is a rare opportunity coming together over the next few months. And it's unusual because it's a rare combination, a very high level of stability in the company's future outlook as a profitable business with an unusual dose of price volatility, which doesn't usually go with that stability. And this is generating unusually high options premiums, which makes for a very good short-term deal that I'm going to cover later. Buffalo Wild Wings owns, operates, and franchises casual dining restaurants, mainly in the U.S. and Canada, but now they're starting to put them abroad as well. It features made-to-order menu items and is best known for buffalo-style chicken wings, which are available with 21 different sauces, and they also have a full bar. You have to understand what Buffalo Wild Wings is doing here. They're taking the cheapest cut of the cheapest meat, putting some sauce on it that costs almost nothing, and then packaging it with TV, costs almost nothing, and creating a party atmosphere that's almost as good as going to the game, sometimes better, in which people are happily paying $50 for a family dinner, basically made up of chicken leftovers, and they do this better than anybody else. Long term, Buffalo Wild Wings targets having 3,000 restaurants worldwide, or roughly triple the current size of the chain. So now let's go after the attention deficit money like the most sophisticated investors are doing. It's true, this is a long-term investment. And one of the things that's required to really make money in the stock market is to believe in what you're doing, understand what you're doing, not invest in things just because you see a crowd doing it. That's how you get the conviction, the courage, the staying power, and the enjoyment of what you're doing, having meaningful investments. But there's also another side. Right now, Buffalo Wild Wings investors are paying too large options premium. Now, I'm not a mind reader, but the stock price volatility is obscuring to some of them the steady 20% increase in sales, profits, and stock price that are almost sure over time, but not from day to day or even from week to week. So first I want to show you what these premiums look like and how do you find these kinds of deals on companies you really want to invest in. Honestly, there really is no formula. I put a lot of time into it, trial and error. I know the companies I'm watching, but I have to keep up with the options premiums so that I can really catch the good deals, special deals when they're there. See, screening for high volatility options deals is a sucker game. When people first find out about these techniques, they go out looking for big premium. There, they're missing the point, and they almost always lose money, because mostly the companies with big options premiums aren't the ones I want to invest in, because I'm looking for stable company performance. Now, in this case, you can see that the people who are afraid of the stock going down are paying a lot of money for insurance. You can see on this page the put premiums. Also, the people who are buying the call premiums are seeing the price of the stock as inexpensive, and they want to speculate on it going up. The bottom line is there are so many novice investors who are traders, who think of themselves as traders, and I say that word traders in quotes because they think being a trader is glamorous. So they're all learning the same thing at the same time from their brokers. They're all bidding up the prices of these options. These option prices are so high right now, we can make as much money and maybe more with less risk just by selling these guys the put and call options that they want to overpay for. Now remember, we're selling them this time. We're not buying. So let's look closely now at the call. Those are the options on buying the stock. I'm committing to sell them the stock at a price much higher than it is now. And for that, they're willing to pay me an outsized premium. Now also, look at the options on selling the stock again. These are called put options. I'm committed to let them sell me the stock at a price much, much lower than now. And you and I know, and these guys forget, that more than 90% of these options expire worthless. That means 90% of these speculators end up with nothing. When I sell them the options, I get to keep the premium no matter what, whether they get exercised or, as is most likely, whether they die a death ignored. Now here's the whole three-part deal. First of all, you can see at the top line, buying the stock. In this case, I'm not buying as much of the stock as I want, but this is a small transaction. Next thing is, in looking at the price of the stock and its future, I couldn't really decide, doing the math, which one was better. There are people who are willing to pay almost $13, $12.75, to buy a call at $145. And remember, the stock was going for $141, just under $141. But they're willing to pay almost $13 for the right to buy the stock at $145. That's $4 higher. Also, people are willing to pay almost $11, $10.77 for the right to buy the stock at $150. Remember, again, the stock is only at $141. So what I did was I split it up. I had 1,600 shares, 8 contracts of 100 each at one strike price, $145, and 8 more at $150. I don't have to know exactly which one. I take a little bit of a smaller premium in order to be a little bit more attached, letting the stock go up a little bit more and me benefiting from appreciation. Now also, the put. There are people willing to pay $9.36 for the right to sell me that stock at $130. And remember again, the stock is around $141. So this is how the investment actually came out. These are the prices, and you can see that this generated around $13,000. So here's the way this works. You can see this on the chart. Now, if the stock doesn't go anywhere but stays in a small range, I get to keep the stock, which I want for the long term, and I get to keep the $33 and change in premiums that those option buyers paid me. Now, if the stock goes up and closes at $150, my take is around $180. I can't even show you that line on this chart because it's way off the chart, $133. Now, if the stock doesn't move at all and I just get to keep the premium, I end up with about $175, and that's the black line at the top of the page. Now, the second thing is, if the stock craters for some reason, I've created a lot more safety for myself because that stock will have to fall all the way down to the pink line for me to lose any money. Anything above that, I have a capital gain on this trade. Even though the stock, when I bought it, was at 141, it has to go all the way down to that pink line just above 110 for me to lose money. Now, bear in mind, I still want to own the stock for its 20% a year growth of sales and profit. That's my real long-term position, for which I have a lot of courage, persistency, stick-to-itiveness, and the joy of ownership. Third, the green line shows that if the stock is sold to me by the guy who bought the put because it went down, my real acquisition price for those shares of stock will actually be the green line, $97. Now that is something I'm dying to buy anyway. Buying that stock at $97 is exactly what I want. Now remember, I only want to do something like this with a company that I really want to invest in because I believe in the company, believe in their mission, and want to own it and give it a chance to grow as they grow their profits and sales at 20% a year. This is not selected because I want to, quote, trade options. The options are a great tool that help me maximize the return and also reduce my risk on an investment that I want to be part of anyway. So here's a little summary of what I've got. I purchased the stock for $225,000. Of course, if you bought it one share of the stock, the proportions are the same. Received call premium, $18,820. Received put premium, $14,981. Total premium received, $33,800 and change. That gives 15% initial premium received on the investment. Since this is only going out 7 months, it's actually a 25.7% annualized return. Plus, I come out with any gain on the stock. Of course, I expect this stock to rise in price and probably over the years 20% a year, plus or minus, just like the profits. But there are no guarantees on this. I'm not a fortune teller. I do know within a reasonable range over time, the stock price, as all stock prices do, will eventually reflect how much money the company makes for its owners. That's why I want to be one of these owners. You can see how effective this option tool can be, especially when hardly anyone understands the tool really and are so eager to overpay. That's one good reason why this is so effective. Folks, I have a 2.5-hour training class on these techniques. I'm offering an early sign-up discount of 20%, which is going to be gone soon. If you want more information on the class, just click the button below. For now, I'll see you on the radio. You can call me live on the radio or email me. The most fun for everybody is going to be if you would like to call me live on the radio at 10 a.m. Eastern Time, 305-541-2350.